Good morning, everyone. Today, our team is going to break down the cash flow statement. My name is Nohemi, and I am presenting with Joe and Josep. To start, I want you to remember one phrase. Revenue is vanity, profit is sanity, but cash is king. This is not just a saying, it is the reality of business. You can show a huge profit on your income statement, but if you have no cash in the bank to pay your employees or suppliers on Friday, you are technically bankrupt. My role today is to explain the difference between profit and cash, and to walk you through the first section, operating activities. First, the difference. The income statement follows accrual accounting. This means if I sell you a product today, I record the sale immediately, even if you promise to pay me in 30 days. I have profit, but I have zero cash. The cash flow statement fixes this. It only records when the money actually hits the bank account. This leads us to the cash flow from operations, or CFO. This is the most critical part of the document. It tells us, is the company generating money from its core business? To calculate this, we start with net income and make two big adjustments. Non-cash items. We add back expenses like depreciation and amortization. Why? Because when we depreciate a machine, we lower our taxes and profit, but we didn't actually write a check to anyone. So we add that cash back. Working capital changes. We look at accounts receivable and inventory. If our inventory goes up, our cash goes down because we spent money to buy those goods. In conclusion, for my part, a positive operating cash flow proves the business model is healthy. But once we have that cash, where does it go? Joe will explain that next.
Thank you, Nohemi. Now that we know how the company earns its cash, we need to answer two questions. Where do we spend it to grow? And how do we get extra money if we need it? This brings us to investing and financing. First, let's look at cash flow from investing. This section is all about the future. It tracks the buying and selling of long-term assets. You will often see a negative number here for successful companies. That's a healthy sign for growth. Don't be alarmed, this is usually good news. A negative number typically means the company is spending money on capital expenditures, known as CapEx. This includes buying new property, building factories, or upgrading technology. If this number is positive, it might mean the company is selling off its equipment or buildings to survive, which can be a warning sign. Basically, investing activities show us if management is betting on the company's growth. Second, we have cash flow from financing, CFF. This section is about the company's relationship with its funders, banks and shareholders. There are two ways we raise capital here, through debt, like loans from banks, and through equity, by giving investors a slice of ownership. If we take a loan from a bank or issue bonds, cash comes in. When we repay the principal of that loan later, cash goes out. That's the basic rhythm of debt. Money in up front, money out when it's paid back. Simple, powerful, and worth remembering. Equity. It pays dividends. Paying dividends is a cash outflow, recorded right here. So, to summarize, investing is how we build our asset base. That's the story. Simple, powerful, and growing. Equity. If the company goes public or sells shares, we receive a massive inflow of cash. However, if the company is profitable and decides to reward its owners, it's the cost of what we owe, our obligation to pay back. And financing is how we pay for it using external money. Now, Chino will help us analyze what these numbers actually mean.
Thanks, Joe. So far, we have the three pillars, operations, investing, and financing. When we sum the totals of these three sections, we get the net change in cash. If we add this change to the cash we had at the beginning of the year, we get the ending cash balance, which matches the balance sheet. But as analysts, our job isn't just to read the total. We need to judge the quality of that cash flow. Not all cash is created equal. Let's look at two scenarios. Scenario A, a company has $1 million in cash flow. But when you look closer, they lost money in operations and sold their factory to get that cash. This is a disaster waiting to happen. Scenario B, another company has negative cash flow. but it's because they generated strong operating cash and decided to spend double that amount building a new tech center. This is a healthy investment in growth. To measure this properly, we use a metric called free cash flow, FCF. The formula is simple: operating cash flow minus capex. Free cash flow is the real money the company gets to keep. It's the cash available to pay back debt, buy back stock, or distribute to shareholders after maintaining the business. Investors always look for high free cash flow. To conclude our presentation, the cash flow statement is the ultimate truth teller. The income statement is based on opinions and accounting rules, but the cash flow statement deals in facts. It tells us about liquidity, can we survive today, and solvency, can we survive the next 10 years. Remember, you can fake profit, but you cannot fake cash. Thank you very much for your time. Does anyone have any questions?